how symmetry creates profits. This was a great idea from one of our viewers, Madison, I believe is his name, and he's emailing me about, can you talk about what you guys talk about, symmetrical entry points and exit points all the time? And we do this probably every few months where we go deep on not necessarily like a market like metals, which we're talking about today, and like, what it means to be trading gold or silver or gold against silver, or, all these different strategies within an asset class, but something today that we can attribute to every asset class, which is the simple notion of, scalping intraday and doing so symmetrically and creating long-term profits. Because and Pete, maybe you can speak to this a little bit to start, like, as recent as, when was the last time you took a loss? Like a lot of options traders and people out there.
About 12 seconds ago, where I bought back some short beans.
Well, because the conversation often becomes like, if I want to create profitability, then I can't be taking losses. But futures, that's a different game. I mean, we're looking at taking losses every single day, and that's just based off of right here, something that we always get back to in our future strategy.
I think if you have a diversified portfolio, you're going to be managing something pretty much every day. And that means taking it off for a winner or a loser. But I would say at a minimum, if you're trading 6 to 10 things, you're going, and that's, combination of a bunch of different strategies and pairs and some options plays, you're going to be managing them on a pretty frequent basis. But between that, there's still those 25% that definitely have a longer term horizon to them. But we're going to talk about, for us, especially for scalping shorter term trades, this idea of symmetry is, when I say protect us, it's almost, that's a dangerous word to use, but it keeps the odds reasonable. And that's, I guess, the safest way you could trade. Symmetrical management is the key to keeping yourself in the game and not letting the statistics of the 50-50 bet get out of control.
Absolutely. And this is, I want to go from start to finish on here. And the start of this, the entry for us that's usually based off of this symmetrical movement is one, on any given day, Pete, you and I are usually willing to both buy or sell any market. Like we usually come into a day with no blinders on to like, I can only sell this market and I can only buy that market. All we're looking for with day trades, with scalps, whatever you want to call it, is like that thing is up a lot or that thing is down a lot. And I want to get on the other side of that move. It's the same for trend followers. It's just the opposite idea, which is that thing is up a lot, I want to buy it. That thing is down a lot, I want to sell it. With us, it's this idea of everything starts the session zero, unchanged from yesterday's close. And I know that's not perfect, but just hang with me here for a second. Zero, unchanged. Now, when the thing moves really far up or really far down, that's when we get intrigued. And we usually get on the other side of these moves, Pete, because markets tend not to show outlier action. We're looking at metals here today, and this has been the scenario for the last year in metals, ever since the big run up in gold and silver in the summer of 2020, Pete. We haven't seen, outside of maybe a handful of outlier single days, we haven't seen sustained outliers in this market for 250 trading days.
Yeah, absolutely. So, when you say sustained outliers, I get what you're saying there too, but it depends on, what we talk about as an outlier. But I agree with you in terms of that concept. I think in my mind, I kind of look at it slightly different than you do, though.
Go ahead. Well, what's the way that you look? Because, like, to me, a sustained outlier is that initial run up from gold. When we went to, in a matter of a couple of weeks, we went to trading around 1,600 in gold to trading around 1,900 in gold. Now, that's one that guys like you and me are going to take losses on. But since then, we haven't seen any real shakeup. If anything, like the 2021 version of 2020 for metals is that ag market. But even so, that
No.
ag market has come back significantly. That's what I mean by sustained outlier.
Absolutely. And I like that, because a sustained outlier oftentimes is the start of setting up this tradable range
Exactly.
we like. So does it print 1900, come right off and give us the range? No, but it will sit and bounce back there. I don't even remember if we got to 2000. I think we traded above 2000. I got to go back and
sure.
look. But that battle, it takes place up there, and we participate, but that sets one side of it, and then we set the other side of it. Mm-hmm. And then we have our tradable range, which is ultimately what we want, because while we may get some doubles, maybe a triple on some of these bigger moves, especially when vol expands, the consistency, what smooths our P&L, is the symmetry around once that work has been done by whoever does that work, which is the guys who blasted from 1650 to 17 to 18 to 1900. I don't care who does it or the reason they're doing it. I just like the fact that that's giving us the opportunity. That outlier move is now giving us the opportunity to find a tradable range.
Yeah, because you and I, this is like a good piece of wording for me. Like, markets tend not to move with sustain. That just like tells me that every couple of occurrences, I'm going to get hit for a loss. Like I'm going to sell into gold is going to move from 1700 to 1800. I'm going to get short, and then it's going to go to 1900. And it's like, all right, I lost. But after that trip up to, like you said, even at one point above 2000, which correlated to about $80 in the SPRE futures, which also incorporates silver, the market didn't move anywhere, which is to say, like, it showed big moves, but it didn't go anywhere. We're literally exactly where we were around the start of July in 2020, but we've seen big moves in the interim, and it's set up for many trades like yesterday, Pete, where you see this metals market down. Gold was down, like $30 or so yesterday, silver down a percentage point and a half. And you look at that and you say, okay, and this is what is so different for active real traders relative to talking heads online. Maybe I guess we are technically right now talking heads online, but you know what I mean? Like people who are like, oh, gold just went to 2000, it's blasting off to 3000. And it's like, all right, that person's neither going to buy or sell gold. So who the hell cares what they have to say? The same thing with this downside, where you've seen a collapse in a few different asset classes, metals being one of them. And everyone's like, oh, gold is going back to zero. Like gold is done for. Right. Real traders step in on a day like yesterday when gold and silver are both down more than 1% and just say, hey, I don't think we're going to see a big outlier here today. I'll buy the market down, 1 to 2% here, and then take advantage of the bounce back. This is a prime example of what we talk about with like trading the other side of a potential outlier, right?
Absolutely. And that's exactly what we're trying to do here, is look at both sides of that market. So, and it's interesting because even though we've now laid out this thing, we're going to let the market do its work for us and help set that range. And granted, it's a challenge because equities wise, we would have thought that range would have been set 10% ago.
Sure.
And I'm conservative, I think. Sometimes it doesn't work that way. But once we do get that range set, we're looking to take advantage of that. The challenge always is when we got down to, we were down to, 73, 70, even 74 in SPRE. And it was like, boy, this, we're just trading 79 and a half, 79s. Do I really want to buy the bottom here? It feels like this market's just, the wheels are going to come off of it at 73. Well, if we're going to accept the new range, we're going to have to deal with a little bit of that uncomfortable nature of feeling we're buying right before Thelma and Louise go off the cliff. I knew you'd know that one.
Is that what happens?
Oh, please. Like you haven't watched that movie 100 times.
I've never seen it. I know the reference, but is that how it ends? They drive off a cliff?
I believe so.
Oh.
Spoiler alert. because you're going to watch that movie?
No, I'll never watch it.
If I stapled your hands to the couch, you would find a way to get.
I'm sure it's good. I'm not a movie guy. I got too much below deck I need to watch. Anyway, speaking of cliffs, Pete, here is like it's never all rosy, right? Like. And this is where you have to be. And
that's my point, is where the symmetrical piece of this is that, okay, I don't feel comfortable at these lows, although we find that they do work for us. Symmetry is not what saves us, but gives us comfort around trading in that range. And I think that's where you're going a little bit, if I'm not mistaken.
No, absolutely. Because you bring up this idea of comfort, and you bring up this idea of like, yeah, on the big days, like the big days, like yesterday was a big day that turned into an inside day. But every once in a while, you do get those outliers. You do get those big days that turn into bigger days, like we saw just about a week ago, or maybe it was 2 weeks ago, when metals did move from, where they had been trading for a couple of weeks, a little bit lower. And to reduce uncomfortable feelings, to reduce losses and increase long-term success, you have to be okay with getting rid of that trade. I mean, you and I were literally on the phone earlier today, and that USDA grain report comes out, and corn skyrockets, and you just go, oh crap, like I got to cover this position for a loser. And that's fine. Like that happens all the time. But if you don't do that, your losses are going to outweigh your gains. And then you become
I still have a few that I'm short that in the market's limit up. So I need you, the last four of your account number, to move these babies into it. So,
but either way, Pete, you have to take those losses, and you have to do it in a symmetrical, because then all you need with the low fees that small exchange products have for you, there's almost no VIG on any of your day trades there.
No friction, no VIG. So in other words, I don't have to make money. This is what hurts so many guys when they came off the floor. Because when you started on the floor, really, what was your cost of doing business? A stack of trading cards in your pocket. Really, that was in a pencil or a pen. You weren't allowed to use pencils. I cheated. But I told you my pencil story where a guy was trying to climb up and get a trade. And I didn't do this on person, but I swung my hand down, and the mechanical pencil, I pulled it back, and the lead was just sticking out of his head. So one of many interesting pit stories. But the idea here of maintaining that. So there was a situation where your friction or your cost of doing business was so low. Guys moved off the floor. They had to have all the screens. They were buying elaborate systems and crazy things that would like yell at them.
I need this data feed, and I need that data feed, and I need to have Australian debt, and I need to have all this crap. Yeah.
And all that added up to is a huge nut before you could make a dollar that you had to cover, that made it almost impossible for anyone to make money. So I think that's where we're going here. The friction cost, VIG, whatever we want to call it, is so small now. It is statistically important to us to be profitable.
Yeah, absolutely. And this is truly how Symmetry does create those long-term profits, because with that reduced friction, with smaller products, with the ability, Pete, to manage $50 losses, $50 profits, $100 losses, $100 profits, with these small products that don't happen like that, where it's like, oh, I needed to manage $100 ago and it got away from me. With all these things, Pete, all you need is a statistical edge of just of just 1% in your favor, and that creates long-term profits. I mean, it's as simple as having 101 trades, being one better in the win column, and that symmetry leads you to a positive P&L. Now, of course, you want to be 2 or 3 or 4. Some people even get close to 10% worth of edge in their favor there. That really enhances those long-term profits. But once again, being honest with that symmetry, taking those losses, having both good and bad days, but making sure that they're near equal, that's what creates long-term profits there in trading futures. So thanks so much for joining me here today, Pete. It's been fun as always. Let's get the hell out of here. We've got a lot of futures trading to do. The markets are moving, especially those ags we'll talk about being limit up and everything else on the next program. Everybody stick around for Splash into Futures coming up next.